Overtrading isn't just about taking too many individual trades. The most dangerous form of overtrading happens when you can't walk away from your computer even when you should. You hit your daily profit target, but keep trading because the market looks too good to miss. You reach your daily loss limit, but convince yourself that just one more trade will turn everything around. This inability to stop when you should is what separates successful traders from those who blow up their accounts. The psychology behind this type of overtrading is fascinating and deeply human. When you're making money, your brain gets flooded with dopamine, the same chemical released when people gamble, use drugs, or engage in other addictive behaviors. You start feeling invincible, like you've cracked the code and can't possibly lose. The market seems to be handing you free money, and walking away feels like leaving cash on the table. On the flip side, when you're losing money, your brain goes into survival mode. Every loss feels like a personal attack, and the urge to fight back becomes overwhelming. You start thinking that you're due for a winner, that the market can't possibly keep going against you. The idea of ending the day with a loss becomes unacceptable, so you keep trading, hoping to break even or turn a small profit. This is where money management psychology becomes crucial. Smart traders set daily profit and loss limits, not just as numbers on a spreadsheet, but as psychological barriers that protect them from their own emotions. These limits force you to make decisions when you're calm and rational, not when you're high on winning or desperate from losing. Let's talk about hitting your daily profit target first. You plan to make $300 for the day, and by noon, you've already made that amount. Your logical brain knows you should stop, take the win, and enjoy the rest of your day. But then you look at the charts and see what looks like another perfect setup. Your emotional brain starts whispering that you could double your daily profit, maybe even make enough to take tomorrow off. This is where most traders make their biggest mistake. They convince themselves that they're trading with the market's money now, not their own. This is completely false thinking. Those profits belong to you the moment you close the winning trade. Risking them on additional trades is no different from risking your original capital. The market doesn't distinguish between money you started with and money you just made. The seductive nature of continuing to trade after hitting your daily target is incredibly powerful. You feel like you're in the zone, reading the market perfectly. Every move seems obvious, every setup looks like guaranteed money. This feeling of being unstoppable is exactly when you're most likely to make catastrophic mistakes. Overconfidence leads to bigger position sizes, ignored warning signs, and poor risk management. What usually happens when you keep trading after hitting your daily target is predictable and painful. You give back some of your profits, which makes you want to trade more to get them back. This starts a cycle where you're no longer trading with a clear head, but rather trying to maintain an arbitrary profit number. Your decision-making becomes clouded by the fear of losing money you've already made. The psychology of hitting your daily loss limit is equally challenging, but in a different way. Let's say you've decided that losing $200 in a day is your maximum acceptable loss. You hit that number, and every rational part of your brain knows you should shut down your computer and walk away. But the emotional part of your brain is screaming at you to keep fighting. You start telling yourself stories about why this loss limit doesn't really apply today. Maybe you blame bad luck, unusual market conditions, or some news event that threw off your analysis. You convince yourself that your system is sound and you just need one good trade to prove it. This is your ego trying to protect itself from admitting that today just wasn't your day. The most dangerous thought pattern when you hit your daily loss limit is believing that you're due for a winner. This is called the gambler's fallacy, and it's completely false. Each trade is independent of the previous ones. The market doesn't know or care that you've lost money, and it certainly doesn't owe you anything. Continuing to trade after hitting your loss limit almost always leads to bigger losses and more emotional damage. Here's what makes this type of overtrading so destructive. It turns trading from a business into an emotional battleground. When you can't walk away at predetermined levels, you're no longer making business decisions based on market analysis. Instead, you're making emotional decisions based on fear, greed, hope, and desperation. These emotions are the enemy of profitable trading. The solution isn't complicated, but it requires incredible mental discipline. You need to treat your daily profit and loss limits like physical laws of nature, not suggestions. When you hit your daily profit target, you celebrate and walk away, no matter how good the next setup looks. When you hit your daily loss limit, you accept the loss and walk away, no matter how confident you feel about recovering. This requires a fundamental shift in how you think about trading success. Instead of measuring success by how much money you make in a single day, you need to measure it by how well you follow your rules. The day you hit your profit target and walk away, even if the market continues without you, is a successful day. The day you hit your loss limit and stop trading, even if you're burning to keep going, is also a successful day. To develop this discipline, start by making your daily limits smaller and more realistic. If you're struggling to walk away at a $500 profit target, try setting it at $200. The goal is to practice the behavior of stopping when you should, regardless of the dollar amount. You can always increase your limits as your discipline improves. Create a physical ritual around hitting your limits. When you reach your daily target, immediately close your trading platform. Write down what you learned from the day and do something enjoyable away from the computer. When you hit your loss limit, do the same thing. This physical act of shutting down and walking away helps reinforce the psychological boundary. Keep a journal focused specifically on the times you wanted to keep trading but didn't. Write down what you were feeling, what setups you thought you were missing, and what ultimately happened in the market after you stopped. Over time, you'll likely see that most of the opportunities you thought you were missing either didn't work out or weren't as good as they initially appeared. Remember that trading is a marathon, not a sprint. Your daily limits aren't designed to maximize every single day's potential. They're designed to protect your capital and your emotional well-being over the long term. The trader who consistently makes $200 a day while protecting their downside will vastly outperform the trader who makes $1,000 one day and loses $800 the next. The most successful futures traders understand that their biggest competition isn't the market or other traders. It's their own psychology. Learning to walk away when you should, whether you're winning or losing, is one of the most valuable skills you can develop. It's also one of the hardest because it requires you to act against your natural emotional impulses. Practice this discipline every single day, even when it feels unnecessary. The habit of respecting your limits when it's easy will serve you well when it becomes difficult. Trading success isn't about maximizing every opportunity or recovering every loss. It's about consistent, disciplined decision-making that compounds over time into significant profits.